Thank you for tuning in to another episode of Retire Right. On today's episode, we're discussing a pattern that seems silly on the surface, but can actually tell us a lot about what's going on in the market, especially with investor psychology. When a particular theme or narrative becomes dominant in the markets, struggling companies or even, I would say scammers often try to ride that narrative with the attempt of pumping up stock prices or valuations. And in the short term, it often works, which is actually kind of the scary thing.
1, 2, 3,
4. Before we actually get into it, it's been a little bit. So, gentlemen, what's new and exciting in life?
Well, on my side, we had a great vacation in Hawaii, and about a little over a week. Second time there. Looking forward to the summer, and finally, I get to go outside to bike instead of sitting in my workout room in the wintertime, which can be pretty boring when you're doing a 2-hour ride.
Although I would say that this weather that, most of you know, I'm sure, but we're located in Pittsburgh, Pennsylvania, and for those of you not located in Pennsylvania, the weather here can be all over the place. And so today, it's late April. It was
30-some degrees.
Freezing, terrible.
Yeah.
Nick, anything new and exciting with you?
I'm just trying to get the golf game from the sim to the course early in the season here. That's the focus.
Financial advisor, father, golfer. That describes Nick in a
bad golfer.
Oh, you forgot an incredible husband too.
Yes. I'm sure she's listening and she will appreciate that. So, Ron, can you talk to us about what we recently saw that inspired this episode?
Yeah, so I was in the morning and in the evening, and I like to really tune into what's been happening with the markets. And I saw this company called Allbirds. The company skyrocketed 600% in a day. So I read into it a little bit. It's a shoe company that decided its stock price from the initial IPO and initial public offering in 2021 went down about 90%. So they decided they're going to sell off the shoe assets for pennies on the dollar and become, quote, an AI company. I don't think they really have a strategy mapped out, but as soon as they made the announcement, the stock skyrocketed 600% in a day. And even though it's pulled back a little bit, it's up about 400% still from when they mentioned their strategy.
Yeah, so Allbirds, they originally started out, I believe, in the Silicon Valley area.
Yeah, right.
They were, again, kind of off speculation. People thought that they were going to be like the new Nike at the time.
Exactly.
And then obviously that never really panned out. And I think that when they sold their assets, I think it was like $30 million or something that they, when they sold everything off, that's what they generated.
It was nothing. It was really nothing. And it was really funny. They started off as an ESG company, right? Mm-hmm. And now with their AI twist, they're still going to maintain that part of it. So
I have one friend that he loves Allbirds, so I'm actually pretty familiar with that company. But anything else that you want to share around some just background context around what inspired this episode?
Yeah, it's just they have no operating capacity right now in regard to AI. It's just the market is so excited about AI that any company that says they put AI in a name, they say they're going AI, just skyrockets. And people weren't paying attention to the fundamentals, like, what do you pay for what do you get? And we'll get into that a little bit later. Mm-hmm.
So, I mean, at first glance, it's kind of unbelievable, but this isn't a foreign, concept or pattern. We've seen this before, and what's interesting is that the move doesn't require execution. The announcement itself is the execution. Nick, I think that you have an example of this that involves crypto, right?
One of my favorite market stories. So cast your mind back to 2017, 2018. Crypto is going up parabolic. It's changing the world, allegedly. And so a company called the Long Island Iced Tea Corporation, based in Farmingdale, Long Island, they literally make iced tea and lemonade. That's the business. December 2017, they renamed themselves Long Blockchain Corporation, and they are pivoting to crypto hard, according to the announcement. The stock's up about 300% in a single day. But just like the Allbirds story, they didn't know anything about blockchain or programming or anything related to any of that. Eventually, they were delisted from the NASDAQ, and the business just collapsed. So, like you guys were talking about, they were just hijacking a story. There was no substance to it whatsoever, but the market didn't care until further on when nothing ever materialized. It did.
Okay, so we'll look at that as kind of like a one-off related to crypto, but I think if we look back in time in the late 90s, you probably saw this more than just once during the dot-com bubble.
Oh my gosh, yeah.
Ron, can you give us some examples from that period?
Sure. That was probably investment-wise the toughest time for me to be in the business because I didn't get sucked into the dot-com mania. I wasn't willing to pay ridiculous prices for companies with no fundamentals. Eventually, I was proven right, but it took a little bit of time. But one example is a company called theglobe.com.
Let's actually back up before you get into that, if you don't mind. I know that we say it a lot on the episode, and I'm sure that I've asked you to explain it
right.
when you've said it in the past.
I know where you're going with this.
Just like when you say I wasn't willing to pay a lot for a company that had no fundamentals.
Yes.
What do you really mean in simple terms by the fundamental part?
So fundamentals are just, does the company have real sales? Are they making money, right? Do they have earnings? Do they have cash flows? Those are fundamentals, right? It's a real company with substance. And then what you want to do is say, okay, this is a good company. Let's pay a reasonable price for a good company. That's all it is.
And so what that really looks like is there are certain ratios that are well known that you can use where you actually look at the fundamental data of the company to come up with some level of a justifiable price.
Absolutely,
Gotcha.
right.
Okay.
And so, back then a company like Cisco, which was was a very good company, was trading like 150 times earnings, kind of rich, very rich. So going back to the globe.com, it decides to come out public. All it does is have the .com name on it, really no business plan. The stock went up about 600% in one day, very similar to Allbirds. But then, of course, when the .com bubble imploded, it fell 99%, was delisted, basically became worthless. So this is a repetitive process. You get some new technology, people get excited about it, they jump into something with a name, .com or crypto or AI, and they don't look at the company.
Okay, so I'd say that these are, relatively modern examples. Can you take it further? Go back further in history, and if you do you tend to see the same thing happening? Nick, I'll pass that to you.
This is a timeless pattern. Like the first caveman who had a wheel, some other caveman was like, I'm launching a wheel company that didn't know how to make wheels. I'm convinced. So anyway, a better example, let's go with the early 1700s. So we're way back in time now. At the time, the new technology was just like, we can sail across the ocean and get spices. And we're psyched about that. That trade, global trade for stuff that comes from foreign countries is the AI of the time in terms of technological advancement. It's a company called the South Sea Company that is positioned to basically run trade with South America, between South America and England. And this thing went parabolic. Dozens of copycat companies launched at the time. just saying, we're going to do trade two, we're going to do trade two. There's a famous story, possibly apocryphal, that a company was launched that had a like something along the lines of very serious mission, but we don't know what it is yet. Like that's literally the type of stuff that was going on. So the South Sea company, the stock went up about 10 times in a single year. All these other companies launched, but none of it was sustainable. It's literally the same thing we're talking about with the crypto, with these like speculative AI things, with the globe.com. Eventually, it all goes to zero, massive investor losses. There's government scandal and investigations of insider trading. And a fun fact, Isaac Newton, the famous philosopher, mathematician, lost 20,000 pounds in the South Sea crash. That is millions of dollars in today's dollars. And so the South Sea company itself and these copycat companies are a very early example of just like ride the story, raise money, which we're seeing in all these examples. But the bonus lesson is the Isaac Newton story, which is you can be a super smart person and still get caught up in this stuff and still lose a bunch of money.
So I have two questions. The first question is, when companies do this, we said it earlier that they don't really have necessarily like a plan yet, but the actual, the name change in this case, signaling, hey, this is now an AI company.
Right.
That's the initial execution, or that's the initial plan. So the stock price surges, the company's value goes up almost instantaneously. What are companies doing with that historically? Is there any themes there?
When you say doing with that, like the
they have the increased valuation, but they have no plan. It seems like there's a limited runway before markets might realize, at least historically, that hey, this isn't making sense.
I have a feeling, and this is just speculation, that the owners, after some of the main people in the company, after the stock runs up a lot, probably take their profits and go. And a lot of these companies end up being bankrupt. Please, again, that's my feeling. I could be wrong.
There's a little bit of like selfishness in this as well.
I have a feeling it might have something to do with it.
With the iced tea company, there was a investigation that went on afterward. I don't recall what the outcome of it was, but there's varying degrees of above board that go along with this stuff.
And so piggybacking off of what Nick said, so you can be an extremely intelligent person, but what happens is we're all emotional, and when you see something flying, up 600% in a day, it attracts attention. A lot of people say, "I want some of that," expecting it's going to go up more, but that's not how it works long term.
Is it more institutional money kind of flooding in, or retail, or both?
I would think it's more retail, but I haven't looked at the numbers. Nick, do you have a feeling on that?
The industry says it's more retail.
Yeah.
I think typically it is more retail, but there's probably some institutional flow as well.
Schedule your complimentary review with Ryan and his team today. Just visit them online at wyzewealthadvisors.com or call 724-271-7019 to get started. That's 724-271-7019 to get started.
You look at what's going on underneath all this craziness, or whatever word you want to use, and we spend a lot of time talking about how efficient markets are at pricing in new information. I guess the thing that I'm confused on is, how does this keep on happening? Usually in the markets, you assume that big mistakes like you saw in like the .com bubble, history tends not to repeat itself. You kind of learn from that, but this feels pretty similar. So how does this keep on happening?
It's a fascinating thing. And what happens is there are these feedback loops that form between stories that are told in the marketplace, market prices, and investor behavior. And you need all three to work together for this to happen. Mm-hmm. So first step is the story emerges. And the story is always based on a real thing. AI is real. Internet was real. Blockchain, you can debate how big it's going to be, but it's real. Global trade was real. All those are real things. Then what happens is when the story gets going, companies start to hijack the narrative or try and ride it, which is what we've been talking about on this podcast with the renamings, the strategic pivots, all that stuff. Where the feedback loop really accelerates is there's this loop that starts where the story is really compelling. speculative buyers, a lot of times it's retail, start to buy. Price goes up, and then because the price goes up so dramatically, it starts to validate the story in people's mind, right? Well, it can't be wrong if it went up 600%, you know? Who can argue with 600%? It's really difficult.
That sounds like almost purely emotion right there.
Yeah, and it is. And that can keep rolling and rolling and rolling as long as the price keeps going up over the medium term, right? And like Ron was talking about, when these businesses don't actually have a plan, or when he was talking about the valuation stuff before, eventually you get to a point where the story is just completely divorced from reality, right? And that's when essentially like the only thing that's holding anything up is what the price is doing. And eventually reality takes hold, though, and that's where the consequences that we've talked about come in. Eventually the price doesn't keep going up. People realize that like there's nothing going on here, and that's when the bankruptcies, the delistings, stuff like that happen.
So what does this say, Ron, about where we're at in the AI cycle?
We're probably not early, probably midway through the cycle or getting closer to the end. The market wants to believe in AI, and AI will be an amazing tool. We use it all the time. But just because it's an amazing tool doesn't mean every stock will be amazing. What normally happens is a bunch of competitors jump in, the technology evolves, becomes very useful, but a lot of those technology companies end up not making it. It's hard to determine what company will be the winner. And what history also shows is sometimes the companies that don't jump in right in the beginning but jump in a little bit later can be a winner. The Magnificent Seven, not every one of those companies were the leaders in .com, but they're definitely leaders now. And so the thing I just want to get across is that even, just because technology is going to be useful, you have to always pay attention to what you're paying for what you're getting in the stock.
Sure. So in summary, I would just want to make a few points. So the Allbirds story is not just about Allbirds. It's about what the market's willing to believe right now, to Nick's point. And when a shoe company can spike by 1,600% by just saying the word AI or slapping the word AI on the company name, that narrative, I would say officially detaches them from fundamentals. And that's not necessarily a crash signal, but it's Ron, you said it's mid, maybe late cycle signal. And it tells you that sentiment is running ahead of substance, which is a scary thing.
Absolutely right.
And history rhymes. The internet did change the world. Blockchain did introduce something new. AI, is a transformative technology. The technology doesn't have to be fake for the stocks to get way ahead of reality. The hard lesson is just being right about the technology doesn't mean you're right about the individual stock or the timing. So what do you do with that?
Let me jump in too, if I could. So as it pertains to our portfolios, right, we have one belief that two ways of executing. We have a stock portfolio, which we would never touch junk like this in the stock portfolio. It would never exist, okay? We look very deeply at, again, fundamentals and price and all that good stuff. Our ETF portfolios, what we're trying to do is overweight the good and underweight the bad. I'm being simplistic about it, but that's kind of what you're doing. So junk companies like this hardly ever would enter one of our portfolios on either side of things.
Right. And, with all the information that we were talking about today, what do you do with it? You don't have to call the top. You just have to stay anchored to the question that the market's no longer asking, in my opinion, which is, what does this company actually do, and what am I paying for the fundamentals? And what I'd say is that if you found this episode helpful, there's a good chance someone else in your life is thinking through something very similar. Feel free to share the episode with them. And if you ever want a second opinion on your own situations or situation, we're always happy to help. So we thought this episode would be timely, just given the news that came out late last week. We hope you enjoyed it, and feel free to like and subscribe to the show. Thank you.
This episode's content is for informational purposes only. Opinions expressed herein are solely those of Wyze Wealth Advisors, unless otherwise specifically cited. Material presented is believed to be from reliable sources, and no representations are made by our firm as to other parties' informational accuracy or completeness. All information or ideas provided should be discussed in detail with an advisor, accountant, or legal counsel prior to implementation.